SoFi Technologies Inc. is currently trading at exactly $25.90, down approximately $0.82 or 3.09% on this trading session as of 1:08 p.m. Eastern Time on Thursday, November 20th. The intraday chart shows a distinct downward channel, having opened significantly higher at around $27.88 before succumbed to selling pressure that has gripped the broader fintech sector today. We are seeing a classic retracement scenario where the price action is testing the lower bounds of its recent consolidation zone, specifically looking for support near the $25.40 mark. The immediate movement on the chart tells a story that is vastly different from the headline hysteria you might see on social media feeds or the panic surfacing in retail chat rooms. The expectation right now, given this 3% drop, is that the post-earnings rally has failed, that the momentum is exhausted, and that we are heading back to the single-digit doldrums of previous years. That is the expectation, fear of a trend reversal. The reality, however, is much more nuanced and arguably more bullish for the patient capital. What we are witnessing is a technical ventilation of an overheated asset. SoFi stock had rallied over 81% year-to-date leading into this week, and a pullback of this magnitude is not only healthy, it is mechanically necessary for the next leg up. The market is effectively shaking out the weak hands who bought the top, while institutional investors are likely engaging in dark pool accumulation at these lower volume-weighted average price levels. Common belief suggests that SoFi is inextricably tied to the fluctuating interest rate environment, behaving solely like a levered bank stock that suffers when spreads tighten. People look at the ticker and see a digital bank. They compare it to regional lenders or legacy institutions. But I want to challenge that perspective immediately. If you look closely at the earnings report from Q3 2025 released recently, the narrative has fundamentally shifted. The market is punishing the stock today not because the business is failing, but because the valuation multiples have expanded to a point where perfection is priced in. We are trading at a price-to-earnings multiple of roughly 45 to 48 times, which is a premium that demands flawless execution. Today's drop is a recalibration of that premium, triggered by a sector-wide rotation out of high-beta fintech names like Robinhood and Block, and into more defensive plays. Let's break down the intraday tape because the price action today is offering a masterclass in market psychology. The stock opened strong near $28, but faced immediate rejection at the $28.50 resistance level. This wasn't a coincidence. That level corresponds to a historical supply zone where heavy selling occurred back in early 2024. As the morning progressed, we saw volume spike to over 54 million shares by early afternoon, which is on track to exceed the daily average of 83 million. High volume on a down day is typically bearish, but if you look at the order flow, the selling intensity is diminishing as we approach the $25.50 level. This suggests that the sellers are running out of ammunition and buyers are stepping in to defend the trend. While many retail traders are panic selling their positions, afraid of giving back gains, smart money is likely looking at the broader picture. The correlation we are seeing today with other high-growth assets is telling. For instance, if you track Tesla stock or Nvidia stock today, you will see similar pockets of volatility. These assets are often held in the same growth-focused baskets and ETFs as SoFi. When a large fund decides to trim exposure to the risk-on trade, they sell the entire basket. This means SoFi is falling in sympathy with the broader tech and fintech complex rather than due to a company-specific defect. This is the definition of a buying opportunity for those who understand the difference between systemic risk and idiosyncratic risk. Now, let's widen the lens to the institutional activity, which is the real engine behind this stock's movement. Recent 13F filings covering the third quarter of 2025 show a fascinating divergence. We have major players like Vanguard and BlackRock increasing their positions, treating SoFi as a core holding rather than a speculative trade. Conversely, we have seen some aggressive profit-taking from actively managed funds that likely hit their price targets when the stock crossed $30 recently. This tug-of-war between long-term accumulation and short-term profit-taking is what creates the volatility we are seeing on the screen right now. The fact that institutional ownership has stabilized above 55% is a massive vote of confidence. It means the smart money views SoFi not just as a bank, but as a structural winner in the digitization of finance. To understand why they are holding, we have to look at the competitive landscape. The retail investor has never had more choices. You have Schwab Intelligent Portfolios offering automated wealth management for the passive investor. You have Fidelity with its massive ecosystem of Fidelity Investments, Fidelity ETFs, and Fidelity Mutual Funds, catering to the older, wealthier demographic. Then you have the disruptors. Robinhood stock trading revolutionized the interface, making it game-like and accessible. But where does SoFi fit in? SoFi is positioning itself as the super app that sits right in the middle. Unlike the Robinhood app, which is often criticized for encouraging risky behavior, or the interactive brokers platform, which can feel like operating a spaceship cockpit to the average user, SoFi has managed to blend usability with financial responsibility. The platform's growth metrics are undeniable. In the last quarter alone, they added over 900,000 new members. That is nearly 1 million people who decided that their old bank wasn't doing enough for them. They are cross-buying products at a rate we haven't seen before. A user might join for the high-yield savings account, then take out a personal loan, and then start using SoFi Invest to buy Apple stock or Tesla stock. This financial services productivity loop is not just a marketing slogan, it is a compounding earnings driver. Every time a user adds a second or third product, the profit margin on that customer skyrockets because the customer acquisition cost was already paid up front. This is the unit economic magic that the market is currently trying to price in. We also need to talk about the technology layer, which is the hidden gem in the SoFi portfolio. The company owns Galileo and Technisys. These are the back-end infrastructure providers that power other fintechs. Think of it this way. When you use a different investing sites or a neobank app, there is a good chance SoFi's technology is processing that transaction in the background. This turns SoFi into a toll booth for the entire fintech industry. Even if a competitor wins a customer, SoFi might still get paid. This B2B component is what justifies the tech-like valuation multiples, separating it from a standard individual brokerage or bank. However, we must remain objective. The road ahead is not without potholes. The current price of $25.90 reflects a lot of optimism. The risk here is execution. If the company misses a beat on earnings, if member growth slows from 35% to 20%, the stock could easily re-rate lower. We saw this happen with PayPal and Block in previous years. The market is unforgiving to high flyers that decelerate. Additionally, there is the macro risk. If inflation reignites and the Federal Reserve is forced to keep rates higher for longer, the lending side of SoFi's business, specifically student loan refinancing and mortgages, could face headwinds. While they have diversified, they are not immune to the cost of capital. Let's compare the user experience because this is often where the battle for the next generation of wealth is won. If you open the Fidelity mobile app, you are greeted with a wealth of data, research tools, and access to Fidelity wealth management services. It is robust, professional, and frankly, a bit dense. Then you open the SoFi trading platform. It is clean, social, and integrated. You can see what other investors are buying, read bite-sized news, and manage your checking, savings, and loans in one swipe. It appeals to the 25 to 45-year-old demographic that is currently entering their peak earning years. This demographic shift is a massive tailwind. As these users inherit wealth or increase their income, they are likely to stick with the platform they already use. Interactive brokers trading appeals to the pro. Robinhood Investments appeals to the trader, SoFi appeals to the member who wants their money to work for them holistically. I want to pause here and ask you a question, because your sentiment matters as much as the charts. Comment below how many shares of SoFi you currently hold, and more importantly, at what price point would you consider adding more to your position? Are you waiting for a retest of $24, or do you think we bounce right here at 25? Let me know in the comments. Moving back to the analysis, let's discuss the SoFi Invest platform specifically. It has come a long way. Initially, it was bare bones. Now they offer margin trading, extended hours, and recently they have expanded their SoFi ETFs lineup. They are aggressively competing with Fidelity Brokerage and Schwab by offering access to alternative assets and IPO investing. This democratization of access is key. Previously, getting into an IPO was reserved for high-net-worth clients at Goldman Sachs. Now a SoFi member with a few $1,000s can participate. This feature alone drives massive engagement during hot market cycles. Furthermore, their robo-advisor, similar to Schwab Intelligent Portfolios or the SoFi robo-advisor, uses algorithms to automate online investing for those who don't want to pick stocks. This sticky, passive capital is the holy grail for asset managers because it tends to stay invested through volatility. We also have to talk about the crypto aspect.